The last 10 months have paid off handsomely for investors who have diligently and selectively picked the right kind of stocks. However, chances are that if you have picked banking stocks, then even the best ones did not really meet your return expectations. Rather, the challenges with loan moratoriums, low rate of takes, and risk of NPAs have been a drag on even the best stocks in the sector. Now, creating wealth in banking stocks is possible if you are willing to hold them over a period of time. But it's usually the mergers and acquisitions in private sector banks that turns out to be most lucrative for investors. Hi, I'm Tanushree Banerjee, and today I'm going to take you through some of the math behind one of the most talked about mergers in recent days, the Kotak Bank IndusInd Bank proposed merger. And I will show you with some proofs from the past what could be the real upside in it. Of course, the managements of both the banks are yet to confirm the merger talks. But should the acquisition fructify, it won't be the first time that Uday Kotak has chosen to grow Kotak Mahindra Bank via acquisitions to comply with RBI's shareholding norms. Yes, you heard that right. The primary objective for such acquisitions has been the reduction of promoter stakes in banks as per the RBI mandate. In November 2014, Kotak Mahindra Bank acquired ING Vysya Bank in an all-stock deal. At that time, the deal helped Uday Kotak reduce his shareholding in Kotak Mahindra Bank to 34%. But since April 2020, the promoters' voting rights in the banks are capped at 15%. And only an all stock deal to acquire a smaller bank like IndusInd Bank would help Kotak bring down his stake closer to the RBI mandated threshold of 15%. So, as much as the markets may consider this a rumor, there is certainly merit and urgency in considering such a deal. But before that, let's figure out if the two banks are ideal suitors for each other. Well, here is what you would have come across in the media: the comparison of the brick and mortar presence of the two banks, their branches, ATMs, employees, and assets. But does that really matter? In today's day and age, physical presence of banks has become redundant. Rather, there are so few transactions at the bank branches that most banks tend to adopt technology to minimize branch and employee cost. Therefore, such brick and mortar presence of the two banks cannot help decide if they are the ideal suitors. Rather, what you need to figure out is whether the two banks have capital to lend, whether they can lend responsibly without accumulating NPAs, whether they can lend to generate commensurate returns for you, the shareholder. While both the entities, Kotak and IndusInd, have healthy capital buffers and good return ratios, you need to watch out for the NPAs of their books. For further slippage in this ratio would mean that the upside in the merger would be capped. Now, what is the upside I'm talking about? Taking a look at the pecking order of the top private sector banks in the country, their assets, valuations, and their census weightage. This merger will grow Kotak Bank's loan book by almost 60% within days and make it undeniably the fourth largest private sector bank in the country. But for shareholders of IndusInd Bank, it could mean a big upside in valuations as the merged entity would certainly have a higher Sensex weightage. But has such a thing happened in the past, and do bank mergers pay off quickly? Well, here are the instances in the past wherein large private sector banks chose the inorganic growth route to multiply their loan books quickly, and a good acquisition helped them immensely in quickly boosting their shareholder returns. So you may recall the HDFC Bank Times Bank merger in 2000, HDFC Bank Centurion Bank of Punjab merger in 2008, ICICI Bank Bank of Rajasthan merger in 2010, and more recently the Kotak Bank ING Vysya Bank merger in 2014. And here are some of the mouth-watering returns that the mergers have yielded within a short time of just 2 years. HDFC Bank Times Bank merger yielded 106% in 2 years. HDFC Bank Centurion Bank of Punjab fetched 71% in 2 years. ICICI Bank of Rajasthan merger fetched 39%. And again, Kotak Bank and Jivesha Bank went on to deliver 114% returns in 2 years. Of course, if you've been holding the stock for much longer than this, returns have been much, much higher. What I'm trying to point out is that does the merger have an immediate big impact on the share prices? It certainly does. So you see, the real upside I'm talking about is not whether arithmetically the two banks will have enough branches, ATMs, or employees. What matters here is whether the strengths are complementary and whether the combined entity could compound shareholder returns over the few years. Of course, I will share more details on this proposed merger if and when the share swap ratio is confirmed. But in the meanwhile, if you wish to know which of these two stocks should you act on right away to take advantage of this merger, do check out Equitymaster's free newsletter, The Profit Hunter. I will soon come back to declutter such corporate moves that could create lasting wealth for shareholders. Till then, thank you. Take care.